What does gold at record high levels mean for the dollar? With interest rate cuts on the horizon, what does that mean for Treasury yields and also the price of gold? When was the last time you could buy an asset on a Monday at an all-time high, but then get it on a discount the very next day, just 24 hours later? We're going to answer some of these questions and more. I'm Eric Sapanik. This is John Caro, and welcome back to the Gold Spot. Well, John, it's been one heck of a beginning of the week, and the week continues to just absolutely shock us with the way things are moving. I want to start off by kind of telling everybody, we as gold traders, obviously we like seeing it profit for our clients. However, in my opinion, it's moving too fast. Right now on the year, we're over 50%. That's too quick for gold. Gold, we tend to like to watch it, go up about 10, 15% per year, offsets inflation, gives a good hedge. But when it starts firing out off the way that it is right now, it's concerning. I mean, we've already hit $4,400 an ounce. That is staggering considering that we were 50% less than that just 1 year ago. That is not a sign or a good indication for the dollar strength. John, maybe you can go ahead and describe to our listeners why this concerns us.
It concerns us because gold is a barometer of the temperature and the mood in the world economy and the people who participated. And when you get a 50% increase over 12 months, that's a big red flag. Something's out of balance. Something's going on, maybe that we don't know about yet. Maybe we do. But the reaction is extreme, and extremes in this kind of market are not healthy. One indicator of this is the behavior of the Treasury bond market. What do you see that going to next?
Okay, John. And that's the thing. Like right now, the 10-year Treasury yield is like right around 4%. But the minute we start dropping interest rates, that's going to also devalue the bonds. Devaluing the bonds also gives other countries that are holding Treasury bonds the allure to go ahead and start selling those to buy physical assets that are rising like gold, silver, whatever. That's where the concern comes. So right now, what's really crazy is we're hearing people talk about in the major media right now, which we've never seen before, and that is where to put 20% of your money, which is from places I never thought we'd see it. John, maybe you could tell us a little something about that.
That's right. What we're seeing are things we've never expected to see or hear before from the media. Places like CNBC are saying buy gold or supporting the idea of owning gold. Some of the major institutions, JPMorgan, Ray Dalio's fund, their spokesmen and analysts are talking about adding up to 20% of your asset base in gold. They're worried about the volatility in the bond market. They're worried about the uncertainty in the world economy. And I just get the feeling that they don't really know why the central banks are buying gold by the ton every year.
I know that you and I, when we saw that going the 60-40 split going to a 60-20-20, we shrugged our shoulders like, I can't believe what we're reading right now.
Well, it's what you've heard us say before. What do these guys know that we don't know? The big players are preparing for something and they're buying gold at very large numbers. And we see what Eric talked about before, all-time high, big drop the next day, up and down. These are opportunity moments for people who want to buy gold.
Well, I mean, you think about it too, like the 60-20-20. So they're not saying defer from stocks.
No.
We still want 60% of your money in stocks because that's what they sell. But the 20-20, what they're saying is the safe haven of your actual portfolio, which normally they would be all about Treasury bonds. But now they're saying, no, well, you might want to diversify some of your risk in Treasury bonds and then allocate into gold. That's something that I've never seen out of 20 years of doing this.
Well, what they're really saying is Treasury bonds are no longer low risk. And that's a reflection of the massive debt load that the world is carrying.
Yeah, John. And I mean, the paper market, or also known as the futures market, that's where short-term speculation can kick in and show you the types of radical drops that you see in a short period of time, like the difference between Friday, Monday, Tuesday, and Wednesday. So that was something that we saw a significant drop, and that is for the physical buyer a huge opportunity because it drives down price of your products. People that buy physically are long-term players. They're not short-term players. So this is the classic buy the dip pattern. You can average down if you just bought, or if you're looking to increase your portfolio. These types of dips are the times that you should just, I mean, the iron's hot, strike. You're going to find that that's going to be a smart play for you. I mean, we welcome these dips. This is something that happened, especially during like the housing crash. There was a time period where it went, then took a major correction. Then it surpassed what it had actually done in that period of time from the dip. The trend right now, though, is definitely an upward trend when you look at the longer picture, not just the 2-day pattern. Still, we're remaining very bullish moving forward for the next years. We're thinking years. We're not thinking 30 minutes in the future like so many traders do today.
Yeah, the trend is up, and if you look at the long-term history of gold, corrections are temporary over the long term. And when you see those corrections, it's an opportunity to take advantage of it.
But once again, treasuries, bonds, the dollar, the debt, the personal debt of this country is astronomical. And if you look at like back in 1929, you'll see that what was one of the biggest problems there. There was an insane amount of personal debt and then also government debt that led to the crash of 33. That's the thing that I think people should be paying attention to, is the extraordinary amount of borrowing that's happening right at this moment, and how that actually lines up with history, that where we saw really bad corrections and even recessions, depressions. That is something that you just need to concern yourself with, because these numbers are not fictitious. They don't not mean anything. They mean everything. And don't let somebody tell you that they don't.
You're right, Eric. The numbers do tell a very specific story. They are a reflection of what's going on in the world. If you take a close look at them, you'll see that it's time to act, or time to think about acting. If you don't know what to do, click below and get our rookie mistake guide. It'll be a good refresher of the rules of the road. And if you're a beginner, it'll help you focus on what's going on.
Thank you, John. I think you said it all. Let's go ahead and meet you here next week again on the Gold Spot. Thank you for joining us.
If you enjoyed today's Gold Spot, like or subscribe to both our YouTube and Rumble channels. Also, comment below if you have any questions or if you'd like to hear us talk about a specific topic in a future video.